Welcome to Yahoo Finance Live. I'm Shauna Smith. Let's get you up to speed on the market action. Just about an hour to go in the trading day. You're looking at gains across the board. The Dow up 180 points, S&P up just about 1%. The Nasdaq leading the way up 2%. You see investor sentiment really add to the upside here as we get ready to end the trading week on an upbeat note. We got the latest reading on inflation. This time the PCE report once again showing that inflation pressures are easing. Taking a look inside the Dow, the top performers there, Intel and Procter & Gamble, both of those stocks up on better than expected earnings results. And as we wrap up the week, the Dow and the S&P both on track for their third straight week of gains. All right, we are wrapping up a big week for the economy. Investors are parsing through a series of reports showing inflation in the U.S. is moderating. The Fed's preferred inflation gauge, PCE, showing signs of cooling. The core PCE index is up 4.1% in June from a year ago. The annual rate was the lowest since September of 2021. Joining us now, we want to bring in Mark Zandi, Moody's Analytics chief economist. Mark, it's great to see you. So let's talk about some of the reports that we got this week and also what we heard from Fed Chair Jay Powell. So that PCE print this morning, the latest in a series of inflation prints, really showing that pricing pressures are easing. How do you think the Fed is looking at these series of reports and this trend that we're starting to see?
Well, Shauna, they've got to be taking a lot of solace in it. I mean, these are pretty good numbers. I mean, inflation obviously is still too high. 4% is still double the Fed's inflation target, but everything is moving in the right direction here, and all the trend lines look pretty good. I do a lot of forecasting, forecast lots of different economic data. Some of that I'm very confident in, some not so much. But I'm feeling pretty good that inflation is going to be lower 6 months from now and probably pretty close to target a year from now. And that won't require any more Fed rate hikes. So I think the Fed should be taking, again, a lot of solace in these numbers.
So you think the Fed should be done then, Mark?
I do. I do. I mean, obviously, there's a lot of script to be written here and things happen. But barring something that comes out of completely out of left field, I think the Fed's getting what it wants. It's getting inflation back in the bottle. Economic growth is slowing. The unemployment rate is low and stable. It's the financial system is under a lot of pressure because interest rates are high, and I think raising rates further would put that under undue pressure. So I think you add it all up, it suggests the Fed should be pretty happy where things are and where they're headed.
Well, Powell did talk a little bit earlier this week just about potential cuts. He was saying that it's not going to happen anytime soon, looking ahead into next year. My question to you, though, Mark, is what is it going to take for the Fed to cut? What do they need to see in order to feel more comfortable easing back on their policy?
I think inflation back to target, Shauna. I mean, I think they've got a pretty high bar for cutting rates. Again, the core consumer expenditure deflator, that's what they are targeting, is at 4%, just over 4. It needs to be closer to 2, at least certainly headed in that direction. So that's still a way to go. So I think they need to feel absolutely positively sure that, we're in that ballpark before they start cutting rates. And, once we get there, I think they'll start slowly lowering rates. But that probably won't be until second half of next year going into 2025.
Mark, the PCE print this morning, when it comes to the consumer side of things, personal savings, personal spending, coming in to the upside, it was the biggest jump that we've seen since the start of the year. What's your assessment just of the consumer, the resiliency that we have seen, and whether or not that sort of strength can continue here in the second half?
Yeah, incredible resilience. Consumers are just hanging tough, doing their part. They're not out spending with abandon. They're not doing that, but they're spending like they typically would. Something around 2% real growth, and that's what it's been for more than a year now. So kind of just rock solid, and all the consumer fundamentals look pretty good. Wage growth is now stronger than the rate of inflation, so that means real wage gains. That's real purchasing power starting to improve. I'm painting with a broad brush here. Obviously, there's big differences across income groups, but in totality, debt loads are light. People have locked in the previously low record interest rates, and now, stock prices are within spitting distance of the record high. Housing values are pretty close to the record peaks set back about a year ago. And middle and high income households still have a lot of cash sitting in their checking accounts built up during the pandemic that they can use if they get into a scrape. So I think if you add all that up, it suggests that the consumer, which is the firewall between recession and continued growth, that firewall is holding up very well, holding firm.
Mark, when we talk about the fact that the economy has been holding up extremely well, much better than many of the forecasts had expected here, that print that we got this morning, Atlanta Fed GDP Now model, starting Q3 growth at 3.5%. What signal does that send? And just in terms of the fact that some of these worries about this recession that we have not seen come to fruition, that maybe we're not going to see a recession at all.
Oh, I missed that, Sean. I didn't see the 3.5. It's way too early in the quarter, though. They don't have any. We do the same thing they do, take the monthly data and translate that into what it means for current quarter GDP. And there's just really no data at this point. So I don't think I'd put a lot of weight on that. But, it does suggest that we're coming into Q3 or in Q3 with, some strength, some momentum. And, very clearly, recession is not at all likely, certainly not in Q3. I will say there are a few risks, though, that, make me a little more nervous about Q4, Q1. The one that's coming to the fore here is the potential for a government shutdown. It now looks, I'd say, more than likely that there's going to be a shutdown with the start of the federal fiscal year on October 1, and that could extend out through the entire quarter and into next year, possibly. And if that's the case, that could be a threat. The other thing is student loan borrowers do need to start repaying on their debt. Now, the president did give them a bit of reprieve, telling servicers not to report delinquent borrowers to the Bureau. So there's no penalty for not paying, but still there will be some increase in payment there. So there's a few things that are coming together that make me a little bit nervous about growth going towards the end of the year, beginning of next, but not enough to think that, recession is imminent here or even around the corner.
Mark, let's talk a little bit more just about the risk of a government shutdown, what that potential impact could look like, what the ripple effects could be when we're trying to model that out and exactly see or gauge the extent of that risk. What should we be thinking about?
Well, if it's a week or two or three, no big deal. Obviously, if you're a federal government employee and not getting a paycheck, that's a deal. But, for the broader economy, I don't think it's big enough. But if it extends out for a month, that probably shaves, 2, 3, maybe 0.4% off of the GDP growth in the quarter. It goes on for a quarter. If we're shut down October, November, December, that's a point off of GDP growth, roughly. And, the economy probably is going to be, without it, growing about a point. So you could, construct a scenario where you get a negative print in Q4. And then the other thing that's going to happen is there would be a potential so-called sequestration, under the rules. 1% cut across all discretionary spending. And if that hits in the start of 2024, then that's going to be, a pretty significant headwind going into next year. So, and this is, in most times, not enough to really, push this kind of an economy into recession. But clearly the economy is going to be soft in the weak here in the next 2, 3, 4 quarters, and thus vulnerable to things like this. So hopefully lawmakers get the message and, don't do that. That would not be, very good for the American economy, the American people. So hopefully they don't do that, but that's certainly a risk.
And Mark, one of the other risks that you mentioned there that you have your eye on right now is what's playing out within the banking sector. We had thought that maybe the worst was behind us when we talk about some of the stress in the regional banks. How big of a risk do you still see this potentially being here in the second half?
I worry about it, Shauna. I think as long as interest rates are high, as long as the Fed's got its foot on the brakes and short-term rates are, close to 5.5%, and as long as the yield curve is inverted with short-term rates higher than long-term rates, that means the operating environment for financial institutions, banks and non-bank financial institutions is pretty tough. The other thing to consider is that we are going to see more credit problems. There's a lot of hand-wringing about commercial real estate, but which there should be, but there's going to be more credit problems, consumer lending and C&I lending. The regulatory environment is getting, more difficult for banks for understandable reasons, but their costs are rising, and loan growth is going to be weaker because they're more cautious. So you kind of add all that up, it's a lot of pressure on the system. And, I'm not as worried about the banks because, the Federal Reserve and the Treasury and FDIC that have made it clear they're backstopping the banking system, but the other part of the financial system that provides about half the economy's credit, the non-banks, there the risks are much higher, and it's hard to know what might break. So as long as interest rates are this high, the risks are not inconsequential that something happens that could derail things. Not my baseline, but certainly a threat, certainly a risk.
Certainly something to keep in mind here as we get ready to look forward to the last 2 quarters of the year. All right, Mark Zandi, thanks so much.
Sure thing.
Be sure to tune in next week when Yahoo Finance's Jennifer Schomburger speaks with Chicago Fed President Austin Goolsbee. They're going to discuss the Fed's path to fighting inflation. That's all happening Monday, 9:20 a.m. Eastern Time, right here on Yahoo Finance. All right, well, stocks are looking to end the week on an upbeat note after the Dow did snap its 13-day streak of gains on Thursday. Let's get to Jared Blickery on the floor of the New York Stock Exchange with a closer look at the moves that we're seeing today. Jared.
That's right. It's the end of the week. It's almost the end of the month, and I'm going to take a look at the very end at some month statistics, but let's go to the Wi-Fi Interactive where I'm tracking the NASDAQ up 2% today. Let's check out the 5-day total, 2.1%. You can see came down quite substantially yesterday, but we have made up all of those losses and more. Here's the Dow, which had been leading up about 2/3% over the trailing 5 days. S&P 500 somewhere in the middle, up about 1%. But I just want to see the sector action, and it's really been about communication services this week. Alphabet and also Meta are part of that group. That's XLC up 5%. But after that, you have a pretty healthy mix of materials. That's XLB, energy, tech, consumer discretionary. Everything on the top row, they're outperforming over the last 5 days. And as we head into the close of the quarter, guess what? The 10-year T-note yield back up to almost 4%. It was rejected from this level several times. And I also want to point out the Russell 2000. Over the last 2 months, that would be June and July, it's up almost 12%. This is on track for its best June and July since 1980. So some real outsized strength there. And what I'm going to be looking at Monday is what the Dow and the Dow components have done over the last 2 months versus what they did earlier in the year. Because it was 2 months ago that we really picked up steam with the non-farm payroll report on June 2nd. And here are the outperformers. Anything that's progressing to the right is up substantially this 2-month period. And if it's up over here on the y-axis, it is up year to date. But suffice to say, Caterpillar is one of the leaders. It was down in the first part of the year, but over the last 2 months, really up more than about 25, almost 30%, guys.
All right, Jared Blickery, thanks so much for giving us a perspective here as we get ready to round out the trading week. Well, we are just getting started here on Yahoo Finance Live. Coming up, Biogen has agreed to buy rare disease drug maker Reata Pharmaceuticals. More on what this could mean for the drug maker's future on the other side. Plus, shares of T-Mobile higher today after the mobile carrier announced mixed second quarter results. You're looking at a gain of just about 1.5%. We're going to hear from President and CEO Mike Sievert later in the hour. He's going to speak with Yahoo Finance's Brian Sozzi. Stay tuned. We'll be right back.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Let's do a check of the market sponsored by Tasty Trade. You look at the Dow up nearly 200 points, the S&P up about 1%. The leadership today coming from the NASDAQ technology sector, one of the outperformers in the trading action today. You're looking at the NASDAQ up just about 2%. And flipping over to the VIX, taking a look at where that is trading right now, under a bit of pressure, 1349, with about 43 minutes to go in the trading day. Well, we are about halfway through the second quarter earnings season, and according to data from Refinitiv, we may be hitting at the bottom of the earnings trough here. And according to FactSet, the number of companies reporting positive surprises is above recent averages. Joining me now to break it all down is Michael Green, Simplify Asset Management Chief Strategist and Portfolio Manager. It's great to see you here. So let's talk about some of the moves that we've seen following earnings. So going into this season, the bar was set very low, but when it comes to tech, at least, the bar was set high, given this massive rally that we've seen since the start of the year. What's your assessment, Michael, just of the results that we've gotten this week? And it seems like it was enough here in order for this momentum to continue to the upside.
Yeah, I think the story of the quarter has largely been one that I've heard a couple of your other guests echo, which is there was a lot of concerns, there were a lot of fears, and in general, things have come in much better than expected. We've seen that in the GDP print, we've seen that in inflation data, and we're now seeing it in corporate earnings, which broadly are beating across the spectrum, with a few notable exceptions, things like electric utilities. But for the S&P 500 and for the NASDAQ in total, we're absolutely seeing relatively positive results and relatively positive reactions to those results.
So then what does that signal for growth rates here, for earnings growth in the second half of the year, then looking out into 2024?
Well, I'm not sure that it actually signals all that much for the second half of the year because we have a number of uncertainties as we look forward. If we look at the first half of the year, we saw a number of one-time positives that I think people tend to underappreciate. The first is obviously a huge increase in Social Security that led to a dramatic increases in incomes, particularly for those who are retired. The second component is that the Federal Reserve's pace of rate hikes has actually been so rapid that it has increased the interest that people are receiving on their cash balances, while it's had almost no appreciable impact on the level of interest that is being paid by the corporate or household sector. So we're just not seeing it feed through yet, except in areas like housing. And in housing, of course, we're seeing the adverse effects of that with, homes being sold hitting the lowest levels in basically history. We're actually now down below the levels of the post-global financial crisis in terms of home transactions. So those are some things I think we have to be very careful as we look at for the second half of the year. And then there's one that I think is really underappreciated, which is the state of California, which represents about 15% of federal tax collections, has an extended tax deadline until October. And that's actually contributed to a lot of the data that we're seeing in terms of the dramatic increase in federal deficit. We're seeing individual income taxes down about 20%. Again, remember, California hasn't paid yet. And so that's going to be something that hits in the second half of the year alongside student loans, et cetera. This is going to be a very interesting experience. We've never really gone through something like this where we're seeing these, very interesting dynamics. Central bank policy so far is actually bizarrely stimulative by raising cash incomes and not yet creating the restrictive interest rate conditions because nobody's had to refinance yet.
Well, Michael, when it comes to what the market at least is interpreting from the Fed, it was interesting to me when we heard from Powell earlier this week. When you take a look at the Fed fund futures right now, 80% of traders are expecting the Fed to hold steady at its next meeting. 67% expect the Fed to hold again in November. That messaging from the Fed, do you think the market is just still focused on hearing what it wants to hear and not really taking into account the fact that Powell said, hey, we are leaving the door open and we could very well see another rate hike before the end of the year?
So I actually think that the market is interpreting this correctly. My read of what Powell introduced in terms of the information was maybe a little bit different than what most people heard. I thought it was fascinating that he began in detail in response to Q&A to begin answering the question, what are the conditions required? What would it look like for the Fed to begin cutting? He outlined the dynamic of how he thinks of real rates using the Fed funds versus a forward inflation forecast. And those forward inflation forecasts have retreated so much for 2024 that if I actually look at those numbers, particularly factoring things like owner's equivalent rent, which we're starting to see come down on the shorter term metrics, things like the sticky inflation metrics coming out of the Cleveland Fed, if I exclude shelter, which has that weird OER component that was slow to react going in and is going to be slow to react coming out, that number last month, we're running at an annualized rate of less than 1% inflation on the sticky components. We may actually, and I do think we'll probably see some pressure coming from the commodity sector, in particular oil and gas, which have benefited from the SPR drawdowns. They can cause that to go up a little bit. But if I take Powell at his word, he actually just described interest rate cuts in 2024.
Let's talk about what's going on overseas here, Michael. The Bank of Japan widening its yield curve tolerance band, sending yields across the world higher today. This was the final central bank policy action of what has been an extremely busy week. When you take into account what's happening on a global basis, also what's happening here in the U.S., Michael, how do you think investors should be looking at this and the significance of this just in terms of the reaction that we're already seeing in the bond market here in the U.S. today and also what it could mean for the dollar as well?
Well, I'm going to push back a little bit against that again, because if I look at what happened in the past 3 days, we had Powell testify. That led to a rally in twos, consistent with my interpretation, somewhat of a rally in tens. We then saw the strong GDP print that caused rates to rise. We then saw the Bank of Japan, the expectations that they were going to widen out the yield curve control. That certainly was realized. We've seen Japanese bond yields certainly rise. But in the United States, exactly as you're showing on the screen right now, we're actually now seeing those pull back again. And so in the course of the past 3 days, we're effectively unchanged in terms of interest rates in the United States. Again, I think that speaks to the underlying conditions that the market is looking at where the Fed is and saying, yeah, I don't think you're going that much more.
Yeah, we do have the 10-year yield back below 4%, at least for now. So, Michael, what does all this mean then for investors in terms of how they should be allocated? Where are you seeing that opportunity?
Well, listen, I actually think that what we're looking at right now in terms of the front of the yield curve, twos and in, is really an extraordinary opportunity. I think this actually plays through exactly as I was describing, where individuals who have locked in their mortgages or who have managed to cap their expenses and their interest rate sensitivity on the top side are actually looking at their income to rise significantly simply by being in riskless instruments. We're seeing this in terms of the pressure on bank deposits where money is flowing into money market funds. That to me is actually a pretty sensible trade right now, to be thinking about generating as much risk-free income as you possibly can, particularly as we look at the uncertainties that begin to develop in the back half of the calendar year. And then the last component I would just make is that some of the observations that I made at the beginning part of the year, things like the dramatic increase in Social Security. This year, Social Security rose by 9.2%, huge benefit for those who have a lot of money to invest, who tend to be older and are looking at spending off their Social Security while trying to preserve their assets. If I look at that into 2024, we're not seeing nearly that level of stimulus.
All right, Michael Green, we have to leave it there. Simplify Asset Management Chief Strategist and Portfolio Manager. Thanks so much for joining. Have a great weekend.
Thank you for having me.
Drug maker Biogen making a $7 billion bet to beef up its portfolio. Yahoo Finance's Anjali Kamlani has that story for us. And Anjali, they're buying Reata Pharmaceuticals. So explain us the strategy here.
Okay, so this is a $7.3 billion deal for Biogen. And of course, we know that Biogen has had a little bit of a struggle off of last year and that whole Aduhelm sort of issue. And so what the company is doing right now is it's on a bit of a growth period right now, looking at this acquisition to help boost its pipeline. They've got one drug on the market specifically for rare genetic neuromuscular disorder. And so that is helping with Biogen's pipeline and its product portfolio, which really focuses on some of these rare diseases. So this is where Reata fits in. Now, this is just one move. Of course, we know that in the background, they also have the Leqembi on the market right now, so really strong growth for both, and both do benefit from this. We also know that analysts are looking at this as a positive for the company, saying that it is also a low-risk transaction because it does help short-term with the portfolio, short-term with helping with revenues, 2025 and beyond. So that's sort of where this sits. Generally positive sentiment for this.
And Anjali, there certainly has been a lot of news, a lot of headlines coming out of your industry there, the healthcare space. Also, AWS pushing further into the healthcare space. What can you tell us about this new tool, medical tool, that they're rolling out for doctors?
So it basically is going to help doctors take better notes when they're in patient visits. And this is not new technology. So in some respect, they're kind of late to the market there. But what they do have that's different and is not as widely available is the ability to auto-summarize, highlight medications, highlight medical terms and the like to make doctors' lives and clinicians' lives a lot easier. It does still require, of course, a set of human eyes to overlook. We know that that's big in the healthcare space, making sure to cut down on any sort of potential, negative outcomes or impacts to patients. So the health scribe, as it's been dubbed, is taking the place of scribes. And so what scribes have been over the years is basically a person who kind of follows the doctor around. Typically, you see this in the emergency room. They make sure to take notes in patient charts. There's also telescribes from some companies where a scribe is listening in virtually. So this just kind of gets rid of the human element of it as an additional cost. There have been estimates out there that a human scribe costs anywhere between $30,000 to $50,000. And so this could be a little bit more cost effective and efficient when it comes to scaling it to other specialties outside of the ER. So that's where AWS is kind of pushing in. It's separate, of course, from the Amazon Health efforts that we generally talk about, but it's just another way that AWS is kind of supporting that. They do have other similar types of tools out there for doctors now. So it's just getting into a really competitive space with big tech and health right now.
It's certainly something that I have a feeling we're going to hear a little bit more about going forward here. Right, Anjali Kamlani, thanks so much. Well, coming up, T-Mobile President and CEO Mike Sievert sits down with Brian Sozzi to break down the latest earnings report and how the mobile carrier is attempting to wrestle market share away from Verizon and AT&T. Stay tuned.
I think they would both fold in 5 seconds. I feel like Mark would bring some moves, but in the end, Elon would beat him.
It may be wise to have some sort of contingency plan.
I'll take Elon.
No need to rush, you know. Look, what's the hurry?
Definitely Mark Zuckerberg. He seems like someone who would go a little crazy and beat Elon Musk up, and Elon Musk is like all talk. It'd be embarrassing for him, I think.
I think that's gotta be true.
I think Mark may have the skills.
I do think it's going to be very interesting to see how this plays out.
I'll put my money on Elon though, because I feel like he's a little crazier.
Oh, wait a second, that's the exact opposite.
People say that Mark Zuckerberg actually does like some form of martial arts.
I like jiu-jitsu. I also really like MMA. We have like a mini academy in my garage.
So I guess my money's on him.
It's awesome. I got like a ton of my friends into it.
I don't care.
I don't know, I think Elon Musk probably.
You know, hopefully this can serve as an inspiration for excitement about the future.
I think if they both managed to kill each other, the world would win.
First-time home buyers can't catch a break. It's becoming even more expensive for them to own a starter home. Yahoo Finance's Danny Romero joining us now with more. And Danny, what are we learning just in terms of how much people need to have in order to buy that home?
Yeah, it's a wild goose chase out there to find a starter home. There aren't many starter homes listed on the market. The higher mortgage rates, the high home prices, that is really straining first-time home buyers. The monthly mortgage payment right now is sitting at $1,600. The average home sold went for $243,000, and that is up 2% from a year ago. And why are starter homes so expensive? Well, for one, the lack of supply that's out there, especially on the resale market. And that is fueling competition and pushing up those home prices. Redfin reported that the average buyer is earning about $65,000, and that is up 13%. And so there are some bright spots, Shauna, ahead, Phoenix, San Francisco, Austin, but that does differ from Miami, where it is becoming a little bit more expensive to live there. People are still migrating and flocking to that area due to the warmer weather, but it's still more affordable than other states like California and New York.
Yeah, it certainly is a regional story here, what we're seeing play out with housing. Danny, what about the all-cash offers, those buyers that we've heard so much about during the pandemic, clearly coming in with an advantage? How much activity or how many offers, I guess all cash offers, are we seeing in the housing market today?
Cash buyers are the winner here. Like about a third of the people that bought a starter home were cash buyers, and most of them were real estate investors. And it also benefits them because they're not paying for that higher mortgage rate, so it ends up being less expensive for them. But this brings the issue of the wealth gap that is happening in our country right now. And, we're hearing different stories in the housing market right now that the competition is fierce out there, that there are these bidding wars in some of these overheated areas. But, like we pointed out, there are some bright spots, San Francisco, Austin, Phoenix. Some of those home prices are definitely deflating a little bit, maybe not as much, but it's still, there's still some competition out there, which is very interesting to see in this dynamic where mortgage rates are up to that 7% almost.
Yeah, exactly. What also just speaks to the fact that there really is not many homes available on the market right now. Inventory is so low. So those that are for sale certainly are seeing a lot of attention from potential buyers, I guess. All right, Danny Romero, thanks so much. Well, T-Mobile shares edging higher after the company reported mixed results after the close last night. Profit coming in above analyst expectations, but revenue did fall a bit short of the street's estimates. Yahoo Finance executive editor Brian Sazzi sat down with T-Mobile CEO Mike Sievert and asked him first about his takeaways from the quarter.
It's really simple. Customers are coming to us more. They're staying with us more, and they're buying up our rate card voluntarily. On the coming to us more, do you know this quarter, Q2, was the biggest quarter for a Q2 in 8 years at T-Mobile in terms of postpaid phone net add growth. And we did it in part because of the second thing. They're staying with us. This was the best churning quarter in T-Mobile history, with the lowest churn in the industry for the first time. Then the third thing, they're buying up the rate card. In fact, for the first time ever, we introduced Go 5G Plus, and it instantly became our most popular plan, and it happens to be our most premium plan.
Is this just a factor of
or just a function of T-Mobile being the low price leader in this industry, and that's why you're not seeing, what we're seeing on some of your competitors where people are still having problems paying their bill?
Well, it's interesting. I mean, when you have a network performance like ours, which is twice as fast as the next nearest competitor and reaches twice as much landmass with the fastest version of our 5G, people want more of it. And so they're voluntarily self-selecting up our rate card. And as I said, our most premium offer is also our most popular offer with 60% attach among new customers in Q2.
I think every quarter we have talked, maybe going over 2 years, whatever it is, Mike, you've been consistent in raising your guidance. Why does this continue to happen? And how many more guidance lifts do you think you have in the belt?
Well, over 2.5 years ago at our Analyst Day, we laid out a strategy for this company that showcased that not only would we build the best network, we would have the resources to defend the best value, and we were going to go after massive under-penetrated segments where there's lots of opportunity for T-Mobile. And this is a differentiated strategy. And what we have been delivering ever since then is remarkably consistent execution against that strategy. And that's why we can set goals, beat them, and then raise them.
Talk to us about how you generate cash. You continue to throw off a good amount of free cash. Why are you seemingly creating more of this than a lot of your peers, and how do you plan to spend it?
Well, T-Mobile's cash flows year to date are cash development per revenue dollar. Think of it as cash flow margins, so the highest in the industry. And that's despite having the lowest prices and the fastest growth, things that you would think would suppress cash. And so it's really remarkable. It shows the resilience of our strategy. It shows that we've been able to take our superior spectrum resources and deliver the best network, that with our superior balance sheet, we're able to defend the best value, and we've been out executing. And so because of that, not only are we outgrowing everyone on service revenue top line, but we're translating that into double-digit EBITDA growth, best in the industry, and the highest cash flows per revenue dollar year to date in the industry.
Stock's off its 52-week highs from 7 or 8 months ago. Do you plan to get more aggressive with buybacks this quarter?
Well, the board authorized an initial $14 billion program as part of an aspiration we communicated for up to $60 billion over 3 years. And so we're well on our way. The authorization that we have right now expires in September. And so, we will continue executing against that. And then as a board, we will deliberate about when and how big and when to start the next one. But the thesis that underlies it, which is the massive cash flow expansion of this business, is fully intact.
Well, I have to follow up, Mike. I mean, do you think you can announce something bigger than what you have been executing on?
Well, again, we executed $14 billion. We're almost done with that program. On our way to an aspiration, we talked about a 3-year program of $60 billion. So mathematically, it shows that most of the opportunity is still in front of us. And this, by the way, this cash flow, it doesn't just stop in 25. I mean, this model has been consistent, resilient, reliable. That means you've got 26, 27, 28 to look forward to as well as cash flows continue to evolve on this business.
I really enjoyed the team's breakdown on the earnings call, Mike, about why your margins may be below some of your competitors. Do you think you can close the gap with them?
Well, we have geographical differences. For example, a lot of our backhaul costs flow through OpEx, whereas for them it's CapEx. And we have an offsetting CapEx efficiency. Our CapEx of $9 to $10 billion a year in our current year, as well as our ongoing guidance, is the best in the industry. That's why you have to look at it on a cash basis. And you have to remember that we're outgrowing everybody and defending the lowest prices in the industry, and yet still delivering better cash production per service revenue dollar.
Well, speaking of defending, the past month your competitors have been out there defending what they may or may not have in terms of lead cables in the ground. And that issue reported by the Wall Street Journal has really dented both of those stocks, not yours. Though, do you have any lead cables? Have you identified any problems with inside of your business you're going to have to address?
Well, I am not and don't plan to become an expert on lead leaching. And, so we're a pure play wireless company, so this isn't our issue. But, I saw all that unfold and, I know our friends are dealing with a lot. Some of it may be real, some of it may not. I just don't know.
Fair enough. So take us through, you recently signed a 5-year extension to your contract. That takes you to 2028? What's your vision? What does this company look like by 2028?
Well, first of all, I'm having a ball. I've been here 11 years. I've been CEO for 3.5 years. And part of why I do this is we have an incredible team. And, for us to build something lasting and special in this country, which is a superior way for people to connect, that's so exciting. Our mission is to be the best in the world at connecting customers to their world. And we're on our way. So that's kind of what motivates me. I think you're going to see a company in 2028 that is the market leader, that is the best in the world at connecting customers to their world, that has reshaped itself around technology and AI and machine learning. Our vision to become a deeply data-informed, AI-enabled, digital-first company is something that will make its way more and more into the fore in the coming years. There's so much change to accomplish, so I'm having fun.
What's T-Mobile's role in AI?
Well, we employ AI all across our business. I mean, unlike a lot of people that sort of suddenly discovered it because they heard of ChatGPT last year, we're a technology company. So we've been, AI, as you know, has been around a long time, and we deploy it deeply with our partners in terms of algorithms on how our network prioritizes connections and assigns spectrum bands to each customer. We apply it in our marketing algorithms because we're a pretty sophisticated marketer. We apply it increasingly, and we'll do even more in terms of how we handle and route customer care calls and digitalize and give people self-care opportunities, and how we prioritize capital and projects for our network and many other places in our business. And of course, large language models, which are the kind of new flavor of AI, just open up even more opportunities.
Yeah, I'm gonna have to go back to college, Mike. But before we let you go, since we last spoke, Apple came out with a new headset. It is very expensive. I don't know if I'm getting one, but nonetheless, a lot of people are likely to go out and buy these things. Do you see an opportunity for your business there? I imagine a device like that needs to be connected at very high levels.
Well, I'm very excited about anytime there's new and great things happening in the marketplace. And so that's a big moment. I remember when the first PDAs came out, remember the Newton years ago? Nobody could afford that. And so people said, well, will handheld devices ever be a thing? Look at the world we live in today. And so obviously these are exciting developments. And to your question, what big innovative devices and software solutions need is an ultra high capacity network, because our lives are connected. And that's what we do. We've built the highest capacity network in US history. We're way in front of our competitors, and we intend to defend that lead for years to come.
And just so the younger folks out there realize, PDA is personal digital assistant. Did I get that right, Mike? Did I get it?
You remember the Newton? It was too expensive for anybody to buy. But people said, therefore, nobody would ever have a handheld device. I mean, that's not the world we live in.
I come from the foldable phone era, which, look, we're seeing foldable phones come on now, Mike. I mean, do you see these as a big opportunity? Is this a flash in the pan? I mean, are we going back in time here?
Of course. No, listen, that's exciting. And Samsung's been a real innovator in this area. What we do is we just let the consumer be the guide. And some people have really been attracted to those things. Other people like the big, flat screens. And look, our job is to make sure we partner with all the best and, importantly, connect all those devices to the highest capacity network that's ever been built.
Thanks to T-Mobile CEO Mike Sievert and, of course, our very own Brian Sozzi. All right, coming up, UPS averting a strike by the Teamsters union. But our next guest says that the shipping giant caved as it faces growing competition from FedEx. We'll be right back. UPS averting a strike by the Teamsters union this week. News of the deal lifting a weight off the shipping giant ahead of its second quarter earnings report on August 8th. But investors may have some concerns about the rising costs for Big Brown. Teamsters saying that it was a $30 billion deal. Joining us now for more, we want to bring in Donald Broughton. He's a principal and managing partner at Broughton Capital. Donald, it's great to have you here. So I believe you expected the Teamsters to strike, but they didn't. Why are you a little bit surprised by this deal?
Well, we thought that what was happening was that Sean O'Brien was positioning himself to have some theater, to have some marketing about what he could accomplish for labor, and use that to first get as much as he could, extract as much as he could from corporate UPS, but then use that in turn to go to the Amazon workers and organize them, because I think that's really his long-term goal. He said as much if you just listen.
Donald, what do you think of this deal just in terms of what it means for UPS? Because of what we know, it includes higher wages. And like I just said in the intro there, O'Brien saying that the agreement is worth $30 billion. So is that a good deal, bad deal, do you think, for UPS?
We think it's a bad deal. I mean, if you just look at the straight up, the initial increase in pay, it jumps their wage line by almost $2 billion, $1.95 billion immediately. They're forced to hire 22,000 workers. They're forced to convert 7,500 workers from part-time to full-time. There's many stipulations that, quite frankly, I'm surprised that they agreed to. And the problem with that is this. See, it's one thing that you have to pay a union worker more, but the real cost for many companies in unionized labor is not the per hour fee. It's that you can't get them to do multiple tasks. They're only going to do one thing. They're only going to sort packages. They're only going to drive a truck. They're only going to do one thing. And, throughout any business day, we have different demands, different things that need to be done. I don't know about you, Sean, but I do multiple things. I take out the trash here at Broughton Capital if I need to, right? And you can't do that with a union employee. They'll say to them, well, that's not my job classification. And that lack of flexibility adds cost, and it adds a layer of complexity and an inability, quite frankly, to compete with people who are not unionized, who have more flexible labor, people who will do whatever you need them to do, because they see it as we're just going to get the job done. We're going to take the hill.
Donald, I'm still laughing about the taking out the trash, because I do agree with you. You are forced to do a lot of tasks, daily tasks, that maybe you didn't initially sign up for. But Donald, let's talk about what do you think, I guess, then forces UPS's hand? Were they just too scared, too intimidated by what a potential strike would do to their company in the near term?
Well, I don't think they were frightened as much as they understood what was happening to market share. Understand that these are, part of the beauty of FedEx and UPS is these are large, very expensive networks. There are billions, hundreds of billions of dollars that have been invested over the years. And so that makes them, you can't compete with them. You can't, there's a big moat around those businesses. That's the good news. The bad news is all those costs, all that money's been poured into the ground. And so incremental volume or lower volume has high incremental and decremental margins. If you go look back 5 years ago, when the exact same thing was happening, UPS was trying to negotiate their contract with the Teamsters. The FedEx did something very simple. They went out to customers and they said, look, there probably won't be a strike. But if there is, we're going to take care of the people who are our customers. It wasn't a threat. It was just a simple statement of fact. And as a result, they had not only had an outsized leap in their market share, the amount of incremental business they got, but they actually raised price at a rate almost twice what UPS was. So you can't accuse them of buying that market share. And once you shift, as I can tell you, in my former life, I was a distribution manager. I routed freight for a living before I went to Wall Street. And what I will tell you is this. One of the axioms of that profession is that, price may get you in the door, but service keeps you here. If someone is taking care of, on a consistent basis, picking your things up and getting your things delivered, they're providing the service, you're not going to kick them out. So the customers that have shifted to FedEx aren't going to go back to UPS unless FedEx drops the ball on service. And I'm pretty sure that FedEx is not going to do that. So what I think was happening was this. FedEx was doing the exact same thing, they've said so, that they did 5 years ago. But this time they were actually having even more success because many people, like myself, became convinced that a strike was very possible, if not imminent. I talked to a number of people who still route freight for a living, and they were all went from in the May to late June timeframe, went from there might be a strike to we're planning for a strike. Even UPS themselves made an announcement saying that they were training their white collar workers to do the jobs of the Teamsters, and they thought they could handle 20 to 25% of the volume should there be a strike. That's basically saying that UPS management themselves were expecting a strike. And so when shippers hear that, they think, we don't want our parcels caught in this system. We need to shift over to FedEx. So let's take advantage of this. So they moved. And as you're seeing more and more and more and more volume move over, the UPS management team, I'm sure, got a daily read of how much market share they were losing. They looked up and they said, you know what, we need to stop the bleeding while we can, because they understand that, like I said, the decremental margins, I think, are literally over 35, 40%. And, if you lose $1 billion worth of revenue, that's, $350, $400 million worth of operating profit.
Yeah, heck of a lot of money, and certainly UPS feeling that pressure. Donald Broughton, always great to get your perspective. Thanks so much.
Thank you for having me.
Well, we have been focusing on retirement this week, and Yahoo Finance's Ali Garfinkel and Carrie Hannon took to the streets to ask people whether or not they're saving and planning for when it's time to call it quits from their 9-to-5 and retire. Let's take a listen.
I'm Ali Garfinkel.
Hi, I'm Carrie Hannon.
We are here on the Venice Boardwalk, coming to you from New York City for Yahoo Finance's Retirement Week.
And today we're talking to folks about retirement. Let's get started.
The distant future, just taking a break from work and just taking care of my family.
Anxiety. I just start thinking about retirement savings. I've just heard a lot about not having enough.
Future freedom.
Save early, save often. If you can, at least save at the level that you can get your employer match.
Do you guys have 401ks? Are you thinking about retirement?
Yes, we do have 401ks. Yes. I think we should probably think about retirement more than we do, but it's something we think about. We save a little bit every month and put it aside.
It feels like a long way away right now, but my mom is trying to tell me to start saving for it. I keep meaning to do it, but I keep forgetting to actually go through with it.
401k, no. I work for myself right now, and no, I'm not really thinking about retirement at the moment.
I started a little bit late, but I'm definitely making my way on that.
I'm saving a little bit, yes. My mom told me just don't look at it, just leave it alone.
I do have a Roth IRA, and I have some money in there.
The longer you can continue to work, you can continue to earn some money, you can continue to contribute and not spend your nest egg, I think the better off you're going to be.
I don't have a target for when I retire. I think when my body physically gives up, probably.
Maybe in my late 60s, maybe early 70s.
50 years old.
70 or 80.
Oh, yeah. 70 or 80? Okay. Why so long?
I don't know, it just sounds so intense. I want my life until I'm super old.
I feel like for my generation, it's probably a lot later than normal. It's normally 65, right? Mm-hmm. I'm going to guess 70.
I'm never retiring.
What I would encourage people to think is you've got to transfer that nest egg to what income is.
I learned in economics class that it's very necessary to build a future in retirement.
Do you think you'll work even after you retire?
I'll do something to keep myself busy, 100%, yeah.
I would say yes. I mean, I would do something fun for me that I enjoy, that's art, drawing, whatever.
Not even thinking about that right now. All my money's expendable. When I get it, I get rid of it. I'll save money eventually, but right now I'm not saving it.
Coming up, the closing bell on Wall Street. We're checking in on some of the latest market moves, also the top trending tickers. You're looking at the NASDAQ up nearly 2%. We'll be right back. And that's the closing bell on Wall Street. Let's do a check on the market, sponsored by Tasty Trade. All three of the major averages closing the day in the green. You're looking at the Dow and the S&P posting weekly gains for the third week in a row. The Nasdaq closing up today just about 2%. You're looking at the S&P up about 1%. I believe that's the highest close that we have seen in over a year right now. The highest close since March of 2022. Communication services, the top performing sector of the week, up nearly 5%, the biggest weekly jump that we have seen since mid-March here. All right, checking in on a few of the trending tickers. Yahoo Finance's Josh Schaefer is here to help us break it all down. And Josh, let's start with the first one, and that's Roku. That's closing the day up. Shares moving to the upside of 31%, rallying on better than expected earnings results here from the company. And Josh, I think there's lots of questions going into this report about whether or not Roku was going to hold up given all the macro pressures, questions about the ad market, exactly what that is going to do to Roku. But again, beating the street's expectations here. And investors seem to be pretty excited about this.
Yeah, Sean, it really comes down to just a couple simple numbers here, right? When you look at Roku, what they did in the first quarter versus what they did in the second quarter. So first quarter ad revenue was down 1% year over year. So it was down compared to the year prior. Fast forward to this quarter, the quarter they just reported for, Roku's ad revenue was up 11% year over year. That's just a massive jump, and a jump that I don't think people were fully expecting because, as you said, people have not felt that good about the ad market. There still is questions about the health of the ad market, but it is some positive signs. And one other note that I wanted to highlight there is just getting costs down. Their operation costs down 8% here. It had been up 42% year over year in the prior quarter. So just to be able to manage costs seems like a key thing that investors are focused on here. Again, people still wondering how that macro backdrop is going to affect Roku in the second half of the year, but maybe once those sort of storm clouds clear a little bit, might be better.
Yeah, we know getting costs under control, a huge focal point here for investors, especially what we're seeing play out within this sector. A couple of other data points here that stuck out to me in this earnings report. Active customer accounts, that was up 16% on a year over year basis at 73.5 million. Streaming hours up 21% from a year ago at 25.1 billion. Average revenue per user, though, that was off nearly 8% on a year-over-year basis, so some cause for concern there, at least for Roku.
And then I want to take a look at the energy giants, too. Exxon and Chevron falling today. Exxon missing the street's expectations in Q2 profits, with profits declining 56% since last year. Now, Chevron posted a loss earlier this week, a 48% drop in earnings, down from a year ago, but it did beat the street's expectations. The two oil giants losing a combined $15.5 billion in profits since last year, Shauna.
Yeah, certainly. Some worrisome trends here for Exxon, and we're seeing that pressure on the stock off just about 1%. Their CEO, Darren Woods, trying to put a positive spin on this call, saying that it was nearly twice when it comes to their earnings work right now, nearly twice what they made in the second quarter of 2018. That doubling of earnings reflects our work in the intervening years to reshape our portfolio of businesses, invest in advanced products, also drive a higher level of efficiency and effectiveness. Lots of focus when it comes to Exxon and their presence within the Permian Basin. They also announced record production efforts in that region. It's on track here for overall growth of about 10% this year, but clearly they have been under pressure as we've seen the price of crude under pressure below $80 a barrel. Certainly a headwind here for these larger oil giants.
Right, and I thought it was interesting too, you mentioned Chevron sort of pointing out some positives in the quarter still. I mean, the stock wasn't down that much, right? We're not talking about a massive loss here. And I thought their CFO had an interesting comment to Reuters, also pointing out that if you look at just earnings and profits, they haven't had this good of a quarter. If you took out the second quarter last year, it's their best second quarter since 2011. So really, probably, maybe they're not that disappointed in the quarter.
Yeah, and they're up against very, very tough comps when we're comparing it to what we heard from Exxon back in 2022. All right, let's also take a look at Intel ending the day higher. The company's latest earnings results really a gain of just over 6%, one of the top performers in the Dow. Well, Intel showing some signs that it did return to profitability after 2 straight quarters of losses. CEO Pat Gelsinger attributing the boost to a recovery in PC sales. He also said that the AI boom could potentially help drive sales even higher from here. Clearly, Intel has really struggled with the slowing growth, or really the slowdown that we've seen across the board when it comes to the PC market. So this report really pointed to the fact that maybe the PC market had bottomed in the second quarter, and we're looking for that recovery to hopefully, at least in Gelsinger's eyes, he is very confident that's going to pick up some steam here in the second.
That's the key word here, right, is bottom, right? Mm-hmm. That's a lot of times what you're looking for in these different calls, depending on what the metric was that was falling, is people want to find that bottom because then it means things are probably going to go up, right? So Intel highlighting that PC inventory correction has likely ended and they're going to come into a positive period there. Also, I thought it was interesting, again, talking about OPEX and just savings. They're talking a lot about being able to save over the next couple of years and fixing that cost structure, which is something that people have been very focused on too.
Yeah, they've been very focused on. It certainly seems like the street was encouraged by these results, although some still a bit hesitant. Oppenheimer was out with a note just commenting on these results, saying that they are going to remain on the sidelines as the company's turnaround plans play out. So they're encouraged by the results that they did see this latest quarter, but they also want to see what the numbers look like for the current quarter. And then, of course, as we look ahead to the end of the year. All right, well, we are halfway through the second quarter of earnings. Let's check in on some of the biggest winners and losers so far. And Josh, we got to start off with what we've seen play out in the tech sector so far. And two of the names that stuck out to both of us this week was Meta and Snap. And what we heard from these two names was an extremely different story. Where do you want to start with?
Meta.
Okay, go for it.
Yeah.
On a positive note.
Yeah,
I like it.
It's Friday. It's Friday, the market's up. Let's talk about positive things first, right? I don't know, Meta, it really stuck out to me. You could really look at these stories in similar vein in terms of ad market, right? Yeah. When you think about the fact that Meta says the ad market's doing well, Snapchat's still saying the ad market isn't doing well. Well, maybe one company's just better at providing ads to people on their social media, right? But I thought it was interesting too, when you think about Meta and what happened with this quarter, to see this stock rally again on earnings and really not because of the metaverse was one thing that really stuck out to me. We're still not talking about the metaverse.
Although Zuckerberg in the earnings call did say
he's
about very committed, but yes,
because people are asking about how much they're spending on it, and that's still a long-term concern. But now they're talking about AI, right? AI is what is driving this. I brought with us one quote from the call that says it all, Shauna. Okay. So I'll read this from Meta founder Mark Zuckerberg. He said that investments that we've made over the years in AI, including the billions of dollars we've spent on AI infrastructure, are clearly paying off across our ranking and recommendation systems and improving engagement and monetization. He specifically said later in the call, he thinks AI is contributing to about 7% more time spent on these apps. Of course, then you can make more money with ads, right? So AI actually helping a company make money.
Yeah, exactly. And that is what investors wanted to hear, was questions about how long we would have to wait in order for these companies to start showing how AI is boosting their bottom lines. And to that point, CFO Susan Li also telling analysts on the earnings call that AI helped advertisers better measure the performance of their ads. And like Zuckerberg was saying that they had users spending more time on the platform. Advertisers were spending more money on the platform, given the fact that they had a better gauge of the performance of their ads. So certainly AI contributing to Meta's very impressive quarter. When you take a look at that ad revenue, $31.5 billion, that beat the street's expectations. Now let's compare it to what we heard from Snap, because a totally different story. Their weakness in their advertising business. We know they're investing a lot in their AI tools and what they see as the future, which certainly did pressure profitability, at least in this quarter. But I think just when you take a step back, the story hasn't really changed. Snap continues to struggle against the larger players within this space. They're going up against Meta. They're going up against Google, Alphabet. And they have shown, at least over the last several quarters, that they're lagging pretty far behind, and they're struggling to even just remotely stay in the race.
I mean, we're showing it on the screen right now. We just were with the earnings. If you're not a profitable company and your revenue is shrinking, your stock is going to react like this when you announce earnings, right? They just need to find a way to reinvigorate revenue growth. And right now they don't have that answer. And that's clearly what's weighing on shares. It's the second straight quarter that they've seen a revenue decline. They don't really have another product outside of Snap itself. Maybe the AI chatbot helps it and brings in new customers, but you're sort of just wondering how they build more monetization here. And that path just doesn't look clear right now.
Yeah, it doesn't look clear. A bit of good news though, because we don't want to rain all over everyone's parade. There's some things to get excited about when it comes to Snap. More time spent on its spotlight videos. They did have stable daily active user growth. It could signal maybe a recovery ahead. Certainly some trends that you would want to see in terms of potential future growth. But we'll see what happens there.
You're more positive than me.
I'm more positive. I don't know. I'm trying to find the silver lining here. All right, let's talk about some of the reads on the consumer that we got this week. Josh, we heard from Royal Caribbean. We heard from Southwest. And like was with Meta and Snap, two very different stories here. Let's start on the upbeat note when it comes to Royal Caribbean, because this was just a blockbuster quarter here for the company. The shares, as a result of this, shares hitting the highest level that we've seen since pre-pandemic. CEO Jason Liberty coming out saying that the demand right now is just exceptional, and there's no sign of it slowing down anytime soon.
This is one of the clearest examples, I think, that we have of the overall conversation about the consumer, that people want to spend on experiences and continue to spend on services, right? It's really playing out in the cruise lines, in multiple different cruise lines earnings. You take a look at those stocks throughout this year, they're all rallying at pretty much insane levels at this point. It's been very impressive, but that's been the run, that's been the conversation, and it's really just not surprising to see it come out in the earnings. On the other side, Southwest is dealing with a little bit of something different when it comes to demand, right? They have that demand for people to travel. You probably get on a flight before you go on your cruise. But it was interesting what they highlighted about business demand. Yeah. And so the quote I want to bring up there, the quote from the call that says it all, Shauna, from CEO Bob Jordan, he said it's clear that travel patterns post-pandemic are not what they were pre-pandemic. Some of that is leisure, a lot of that is business. I expect business to continue to come back, but I think it's going to trail the restoration of leisure here for a while. So when does it come back, I think, is the biggest question looming over Southwest.
Yeah, that is a huge question. We've talked to a number of analysts. Savi Seth was one of the analysts that we spoke to earlier this week, just talking about the rebound that some airlines are seeing from their business travel customers. Southwest obviously lagging behind. That's pressuring the company here. And as a result, they're revamping their flight schedules for next year to reflect some of those post-pandemic changes that they are seeing from their customers in regards to their travel patterns here. So contrasting, a huge contrast to what we've heard from so many of their competitors out there in the space. When you take a look at United, American Airlines, clearly in a better position there than Southwest. All right, Josh, this was fun. You got to come back another time to break it all down.
There'll be more earnings next week.
They always are, at least for now. All right, guys, well, it's closing time here at Yahoo Finance. Here's a look at some of the top stories and big movers of the day. Another sign that inflation is cooling. The core PCE index out Friday, showing that prices excluding food and energy rising at a 4.1% annual rate in June. That coming in slightly below expectations, but it's also falling to its lowest rate in nearly 2 years. Palantir, one of the top trending stocks on Yahoo Finance, the stock soaring on an upbeat note from Wedbush's Dan Ives. He initiated coverage on the stock with an outperform rating and a $25 price target. Ives calling Palantir, quote, the Messi of AI and a generational opportunity. He says it is well positioned to take share in both commercial and government markets. Palantir shares close 10% higher on the day. Finally, Barbie having a blockbuster week at the box office. The film bringing in $500 million in global sales in its first week. According to a statement from the studio behind the film, Warner Brothers, Barbie is the best 7-day opening for any of its films. Now for what to watch next week. First up, a slew of tech earnings. We will hear from chipmakers AMD and Qualcomm on Tuesday and Wednesday. Investors watching for further signs of a rebound in the chip business and PC sales coming on the heels of a positive report from Intel. Also next week, reports from two members of the so-called Magnificent Seven, Amazon and Apple, reporting after the bell Thursday. The focus of Amazon's second quarter report will be around AWS growth. Now, Amazon shares sliding after the company's last earnings report on cautious commentary around that slowdown in AWS. In focus at Apple will be investor excitement around the $3,000 Vision Pro headset. Investors also clearly keeping a very close eye on iPhone sales amid a slowdown in the smartphone shipments. And big data for the Fed. We will get a number of job reports, ADP employment, weekly jobless claims, and updates on non-farm payrolls, unemployment rate, and hourly wages. Finally, be sure to tune in to Yahoo Finance on Monday morning when our own Jennifer Schaumburger speaks with Chicago Fed President Austin Goolsbee. They will discuss the Fed's path to fighting inflation. Well, that does it for us today on Yahoo Finance Live. Be sure to come back Monday, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great weekend.